So the stock markets have performed relatively well in the last year. The indices are up significantly, and especially artificial intelligence stocks are performing very, very well. One of the downsides in that environment is that it makes it more challenging to find undervalued or cheap stocks to buy because nearly everything is rising. But I've found two relatively cheap AI stocks you can buy right now that I think will make you long-term gains and it will improve your wealth held over the longer term. So I'm going to share those two stocks with you here and provide you several reasons why I'm bullish on these two investments.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the first stock I'm going to highlight is IBM. And what you're looking at here is my proprietary discounted cash flow valuation model for IBM stock. I forecasted all of the free cash flow I expect this business will generate between today and the very, very long run. And I've discounted those cash flows. I've calculated a weighted average cost of capital, and I've created an intrinsic value per share where I believe it's a fair value to purchase IBM stock. So let's start with the present value of all of the free cash flow I expect IBM will generate between now and the very, very long run. That totals a massive $354 billion. This is a cash flow rich company. It generates significant sums of free cash flow. And if you noticed my recent review of IBM's latest quarterly earnings results, the management team upgraded what they believe they will generate in free cash flow here in 2025, signaling to investors a big increase in free cash flow expectations in the second half of this year. IBM is also accelerating the backlog of orders for its AI business, kind of similar to what I saw with Oracle about a year and a half ago. Before, remember, I rated Oracle stock as one of the best stocks to buy, is because I saw the early signs of a boom in organic demand for Oracle's products and services. And here we are in 2025, and Oracle stock has performed excellently so far. I see similarities in IBM and Oracle in terms of what I'm seeing in the acceleration in the backlog of orders. That's where I see the biggest similarity between IBM and Oracle. Now, the weighted average cost of capital I calculated for IBM is just 8% because this is a relatively stable company, a lower risk company. It has a beta of just 0.69. So the weighted average cost of capital of just 8% is very attractive for long-term investors. That means that the company doesn't have a large hurdle rate to exceed in terms of generating shareholder wealth. When your weighted average cost of capital is lower, your return on invested capital doesn't need to be as high to increase shareholder wealth. That's always a positive, not only for discounting cash flows, but it can also be a competitive advantage for a company who can borrow and raise capital at significantly lower cost than the competition. So if the same project, let's say, cost $50 billion and one company can raise that capital at a cost of capital of just 8%, and another company has to raise that capital at 16%, of course, the company with the lower WACC will win the business because they can get the business at a lower cost because their cost of capital is lower. So the company has a market cap of 244 billion and the intrinsic value per share I calculated is $331. The current market price is $262. So I see this stock as being undervalued or relatively cheap compared to many of the other AI stocks you can buy today. The next AI stock I'm going to recommend and rate as being cheap is Alphabet. I did a very similar calculation with Alphabet using my proprietary discounted cash flow valuation model. And the weighted average cost of capital I calculated for Alphabet is 9.71%, higher than IBM. And that's understandable. Alphabet is less established. Alphabet's free cash flow is more volatile than IBM's free cash flow, and the stock price is more volatile than IBM's stock price. So those are the factors contributing to a higher weighted average cost of capital for Alphabet. Still, I calculated an intrinsic value per share of $231 for Alphabet. The current market price is $192. Alphabet, like IBM, recently reported earnings, and I did several videos evaluating those results, and I liked what I saw from the company. I was especially encouraged by the double-digit increase in the Google search business. That's the business I'm watching most closely because of how consumer behavior is changing, and more searches are going towards large language models, which monetize less effectively than search engine queries and also cost more to serve. And so, for that reason, I'm watching that segment closely, and I've been pleasantly surprised that Alphabet's Google search business continues growing despite changing consumer behavior. Alphabet's management team attributes that to having more effective search, enhancing their search business, enhancing the way they serve those search queries, and at the same time, attributing it to people searching for more things. Search activity overall is increasing. So even though some of that activity is moving towards large language model, the overall search engine activity is increasing as consumers are more confident that they can find answers to the questions they have going online and going to these companies like Alphabet and ChatGPT and others to ask these questions. So that's been good news for the industry overall. So I shared with you my proprietary discounted cash flow valuation models that point to these two companies being relatively cheap. But I also like to look at valuation in other ways. One of those other ways I like to observe is the forward price to earnings ratio. And the company I like to go to for my data right now is fiscal.ai. They have a lot of cool charts like this, and they save me a lot of time in my research. There's a link in the description. If you're interested in joining, you'll get a discount by using my link. Now, the forward price to earnings ratio for Google is surprisingly lower than IBM. It's trading at a forward PE of 20. And I've been talking extensively about how Alphabet stock is undervalued, and I've rated it as one of the best 9 stocks to buy in 2025. Now, the reason Alphabet stock is as cheap as it is because of the risks from the changing consumer behavior to search queries in large language models. If you took that factor out and you just observed Alphabet's business, you looked at the returns on invested capital, you look at revenue growth rates, earnings growth rates, you look at cash flow, you look at the returns on assets, all of which would point to a company that deserves a forward price to earnings of 30 or above. But right now it's trading at 20 because of those risks. Investors are very concerned with those risks. And I think the devaluation as a result of those risks is overdone. I do believe there needs to be some margin of safety applied to Alphabet's business to account for those risks. But I think the margin of safety that's being applied right now is too much. And so I see Alphabet as an opportunity here. IBM, meanwhile, doesn't have the characteristics of a business that deserves a much higher valuation. It's not growing revenue anywhere near as quickly as Alphabet. Its return on invested capital are nowhere near the levels of Alphabet and probably will never be so. And so it doesn't deserve that kind of a premium valuation. So on a forward PE basis, I feel IBM stock is fairly valued when measuring by this metric in particular. But when you combine valuation by incorporating both the forward PE ratio and my proprietary DCF, that's where IBM stock looks cheap. And IBM's revenue growth, in my opinion, will start accelerating in the near term as those backlogs in orders start to turn into revenue, as happens with companies like IBM. So these are two companies that recently reported earnings, and their valuation is relatively cheap for AI stock investors looking to buy and hold for the long term. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.